You've seen the empty dealership lots and the videos gloating about it. Dealers getting what they deserve. Nobody's buying. Wrong story. The buyers didn't disappear. They're sitting in their driveways right now in a car they cannot sell, cannot trade, and cannot escape. Almost 30% of everyone who tried to trade in this quarter owed more than the car was worth. That's not a slow market. That's a locked door. Here are the numbers that explain everything else. In the second quarter of this year, 29.6% of trade-ins toward a new vehicle carried negative equity. The average amount owed above the car's actual value was $6,884, the highest ever recorded for a second quarter. And more than a quarter of those people were $10,000 or deeper. Most people hear the word underwater and picture a minor inconvenience. It isn't. It's the most expensive position you can be in without knowing it. Because that leftover debt doesn't disappear when you trade. It gets rolled into the loan for the next car. You are now financing a vehicle plus a ghost, a car you don't own anymore that you're still making payments on. The average monthly payment for someone who rolled negative equity forward hit $944 this quarter, against an industry average of $777. That ghost costs $167 every month, and over the life of the loan, those buyers are projected to pay $16,270 in interest. The average new car buyer pays $9,811. That's roughly $6,500 extra in pure interest for the privilege of getting out of a car you couldn't afford in the first place. So it isn't the payment that traps you, it's the exit fee, which raises the obvious question, how does anyone still get approved? Simple. You stretch the loan until the payment looks survivable. Of the buyers rolling negative equity into a new loan, 90.2% extended their term to 72 months or longer. 43% went all the way to 84, 7 years, on a car. And here's what 7 years actually does to you. A car loses value fastest in its first 3 years. A loan pays down principal slowest in its first 3 years. Those two curves run in opposite directions, and the space between them is the hole you fall into. By year 2 or 3 of an 84-month loan, you are almost mathematically guaranteed to owe more than the car is worth. That's not malice, it's structure. Nobody in that finance office ran the curve for you, because running the curve isn't what the finance office is for. And the average age of an underwater trade-in right now is 4 years. Exactly the point where people start thinking about their next car. The trap doesn't spring when you sign. It springs the day you try to leave. Now, the comfortable assumption is that this happens to people who bought badly. Some depreciation disaster nobody wanted. The data says otherwise. Edmunds looked at which vehicles carry the highest negative equity balances, and the top of the list isn't obscure. Toyota Tundra owners are rolling an average of $8,929 into their next loan. The Tundra, a full-size truck from the manufacturer people specifically buy because it holds value. Their director of insights put it plainly. When vehicles that were historically safe bets on resale show up underwater, it's a financing problem, not a vehicle choice problem. Read that again, because it's the whole video. You cannot buy your way out of this by picking the right car. The car was never the variable, the loan was. And the floor keeps rising underneath everyone. The average new car in February cost $49,353. 6 years earlier, it was $37,876. That's a 30% jump, and wages did not do that. So now connect it back to that empty showroom. Why is the lot full? Because the pipeline broke at the trade-in. The car business runs on a cycle. You buy, you drive it 3 or 4 years, you trade it. That trade-in becomes used inventory, and you drive off in something new. Every new car sale is powered by a used car coming back through the door. When 30% of those trade-ins are underwater by $7,000, the cycle stops turning. The customer walks in, hears the number, and walks straight back out. No trade-in means no used inventory and no new sale either. The dealer's dead showroom and the customer's inescapable loan are the same event seen from opposite sides of the glass. The industry spent 2021 through 2023 pulling future sales forward at maximum margin. The future arrived, and there's nothing left in it. And that's the part that gets filmed. Here's the part that doesn't, because it doesn't happen on a showroom floor. In January, the share of subprime borrowers, at least 60 days behind on a car payment, hit 6.9%. According to Fitch Ratings, that's a 32-year record, worse than anything logged during the Great Recession. 60 days past due is the line where lenders start seriously considering repossession, and last year repossessions hit roughly 1.73 million vehicles, the most since 2009. Now here's the detail that tells you who is absorbing all of this. Subprime borrowers hold only about 17% of active auto loans, but they account for nearly 2/3 of the delinquent ones. That's not spread across the country. It's concentrated almost entirely on the people who had the least room to absorb it. The same people sold the longest terms at the highest rates, because that was the only way to make the payment fit. Total outstanding auto debt in America now sits around $1.69 trillion across roughly 108 million open accounts. 90-day delinquencies are at 5.60% against a long-term average of 3.59%. Those aren't market numbers anymore. Those are household numbers. If you want the honest version of this industry, subscribe, because it's finally reaching the people who wrote the loans. You've seen the buy here, pay here collapses, operators who spent years paying whatever it took at auction, financing anyone who walked in, betting the interest rate would cover the risk. Some have closed stores and cut over 1,000 jobs. Those loans default at roughly twice the rate of traditional auto lending, but they're around 16 times more likely to end in active repossession, because that is the business model. The car isn't sold to you. It's lent to you with a tow truck attached. And in February, Senator Elizabeth Warren opened a probe into the auto lending and repossession industry, writing to major lenders, the Independent Dealer Association, and the largest buy here, pay here operators. That's what it takes to get attention. Not a viral video, millions of repossessions, and a collapse big enough to reach Senate letterhead. So does anything ever actually change? Occasionally and quietly. Massachusetts now requires every mandatory fee, including the dock fee, to be built into the advertised price of a vehicle. Listing it separately doesn't count. Disclosing it at checkout doesn't count. That sounds small, and it isn't. The entire advertised price game depends on the number you see online being a number you can't actually pay. One state closed that gap by law. There are 49 others where the price on the screen is still an opening bid, which brings it back to the driveway, because that's where this actually lives. If you're underwater right now, you are not in a rare situation. You are in the same position as nearly 1/3 of everyone walking into a dealership. And the worst possible move is exactly the one the industry is built to encourage, trading out of it into a longer loan. Rolling $7,000 into an 84-month note doesn't solve anything. It refinances the problem, adds interest to it, and pushes the reckoning 4 years down the road, where it will be bigger. The boring answer is the only one that works. Keep the car. Keep paying. Let the balance fall past the car's value, because it will. And the day it does is the day you get your options back. Time and payments close that gap. Nothing else does. And if you're buying right now, the leverage really has moved. Lots are full. Inventory is aging. Dealers need units gone. Use it on the price of the car and the length of the loan, never on the size of the monthly payment. The payment is the number they want you staring at, because a payment can be made to say anything. Somebody will walk in tomorrow, sign 84 months, and drive off feeling like they won. In 4 years, they'll be filming a video about how they can't sell their own car, Don't be that video.